So, JPMorgan Chase just reported this massive $16.5 billion in profit for the first quarter of 2026.
Right, which is just huge.
It's massive, but, at the exact same time, they are deliberately hoarding like a staggering $1.5 trillion in cash and liquid assets.
Yeah, as an insurance policy.
Exactly. So my question is, why is the world's most profitable bank preparing for essentially a Category 5 hurricane while the sun is, shining so brightly?
Well, I mean, it's kind of the ultimate contradiction in modern finance, right?
Yeah.
You're looking at this financial institution operating with the immense forward momentum of a nuclear-powered ocean liner, but one that is actively reinforcing its hull for some kind of geopolitical shipwreck.
It's wild. Welcome to this deep dive, everyone. Our mission today is to really tear into JPMorgan Chase's Q1 2026 earnings report.
And there's a lot to unpack.
There really is. We're moving way beyond just the top-line numbers to help you understand what this data actually tells you about the mechanics of global banking. We want to look at the underlying drivers of long-term shareholder value and really how the apex predator of Wall Street manages risk in a highly fractured world.
Because if we look at the raw data you've pulled together for this, the baseline metrics are almost hard to process.
They really are. Let's set the stage with the year-over-year headline, right? So from Q1 2025 to Q1 2026, managed revenue hit $50.5 billion.
Which is a 10% jump.
Right. And that net income we mentioned, $16.5 billion, that represents a 13% increase.
Yeah.
But what really stood out to me immediately was the efficiency at this scale. I mean, we're seeing a diluted earnings per share of $5.94.
Up 17%.
Exactly. And a return on common equity, the ROE, of 19%.
See, maintaining a 19% ROE on a balance sheet of this magnitude, it essentially defies the law of large numbers.
How so?
Well, usually, as a company gets to be this massive, its ability to generate really high returns on shareholder equity kind of degrades.
Right.
It's sluggish.
That makes sense.
But the fact that their EPS growth actually outpaced their net income growth, that shows they aren't just making more total money. The underlying profitability of each individual share is actually accelerating.
Wow. Okay, but wait, let's connect this back to that $1.5 trillion cash hoard we opened with.
And the fortress.
Right, the fortress balance sheet. Because having a strong hull is great, but, holding $1.5 trillion in highly liquid assets feels less like a protective hull and more like a giant anchor dragging down potential yields.
I can see why you think that.
I mean, if they deployed that capital into the market, wouldn't that 19% ROE be even higher?
In theory, yes.
Yeah.
Absolutely. But you have to view this through the lens of the 2008 financial crisis.
Oh, right.
Yeah, that permanently altered how this specific management team views risk. They operate what they literally call a fortress balance sheet.
So what are the actual mechanics behind that?
Well, let's look at the numbers. They reported $291 billion in CET1 capital, which yields a 14.3% ratio. And that's alongside a total loss absorbing capacity of $572 billion.
Okay, for those of you tracking the capital adequacy metrics at home, CET1 isn't just like cash in a vault, right?
No.
It's the core equity buffer. It's the money that absorbs the very first wave of losses before a single depositor loses a dime.
Exactly that. It is the shock absorber. And that $1.5 trillion liquidity buffer you mentioned. Look, in global banking, liquidity is oxygen.
Right.
If a geopolitical event triggers a sudden freeze in the credit markets, JPMorgan doesn't have to scramble. They don't have to sell off long-term assets at a massive discount just to cover their daily obligations.
Because they can just sit on their liquid securities.
Exactly. It's this extreme defensive posture that actually dictates their premium market valuation. Investors know a bank run here is, practically mathematically impossible.
Which makes the growth metrics all the more wild to me. Because despite wearing this heavy armor, the engine is still revving. I mean, average loans reached $1.5 trillion, which is up 11% year over year.
And average deposits grew, too.
Yeah, up 7% to $2.6 trillion. And a significant chunk of that lending growth came from higher revolving balances in card services.
Right, and that dual strategy is really the hallmark of their current operations.
The offense and the defense.
Exactly. They are capturing everyday retail deposits and expanding high-yield credit card lending on Main Street while simultaneously, locking away billions at the macro level.
So, okay, we understand the defense. Let's look under the hood at the offense. The sources break the bank down into three main profit engines.
Right.
Let's start with the Corporate and Investment Bank, or CIB, which just feels like an absolute juggernaut right now. Net income hit $9.0 billion.
which is a 30% jump.
40%, that's massive.
It is. But the metric to really focus on there isn't just the net income. It's the 9.8% wallet share they captured.
Okay, explain that.
Well, it ranks them #1 in global investment banking fees. Basically, out of all the investment banking fees paid by corporations globally in Q1, nearly 1 out of every $10 went straight to JPMorgan.
Wow, 1 out of 10.
Yeah. Total IB fees were $2.9 billion, up 28%.
Now, I actually have to push back on that narrative a little bit.
No.
Yeah, because I was digging into the line items. The data explicitly shows that debt underwriting fees actually fell.
That's true.
And we're in a complex rate environment, so debt issuance dropping makes total sense. But if a major pillar like debt underwriting is taking a hit, how on earth did they engineer a 28% overall increase in banking fees?
See, that is the structural advantage of their sheer breadth.
Okay.
Yes, debt underwriting contracted.
Right.
But they experienced such explosive growth in advisory fees, meaning, mergers, acquisitions, corp restructuring,
Right.
along with equity underwriting, that it completely eclipsed the drop in debt. When one market mechanism seizes up, they just pivot their advisory teams to whatever sector is moving.
Ah, so it's a perfectly hedged operation.
Exactly.
And we see that in the markets division too, right?
Yeah.
Hitting a record $11.6 billion in revenue that was heavily driven by $7.1 billion in fixed income and $4.5 billion in equities.
Which tells us client engagement is incredibly high across all their trading desks.
Makes sense. So if CIB is the high octane engine trading on market volatility, what provides the stable fuel for those operations?
The consumer side.
Right, the Consumer and Community Banking Division. The CCB, net income there was $5.0 billion, up 12%, with a 32% return on equity.
Which is fantastic.
But beyond the profit, I thought the customer acquisition numbers were fascinating. They hit 63 million active mobile customers, that's up 7%, and over 450,000 net new checking accounts.
And you have to understand, those aren't just vanity metrics. That is the technological flywheel in action.
How do you mean?
Well, a digital customer is exponentially more profitable over the long term. Every time one of those 63 million users deposits a check via their phone rather than, walking into a physical branch and taking up a teller's time.
Oh, the marginal cost to serve that customer plummets.
Exactly. It drops off a cliff.
So the heavy upfront investments in tech and mobile infrastructure are directly boosting operational efficiency today.
100%.
They are essentially farming zero-cost deposits from retail customers, which then, I assume, fund the massive lucrative loans happening over on the corporate side.
Precisely. It expands their net interest margin systematically.
Okay, so if you're an investor looking at these numbers, you're probably seeing that 32% ROE in the consumer bank and feeling pretty good.
Definitely.
But then you look at the third engine, Asset and Wealth Management, or AWM, which reported an absurd 44% return on equity.
It's incredible.
When I see a 44% return, my first thought is, why doesn't the bank just dump all of its capital into wealth management and abandon the rest of the businesses?
I mean, it's tempting, right? But you have to understand the underlying mechanics of wealth management. AWM is a capital-light model.
Oh.
It's sort of like being a Hollywood talent agent instead of the movie studio.
Oh, I like that analogy.
Yeah, the studio, in this case, the consumer bank, they have to front millions of dollars in capital to make the movie, taking on all the risk of a flop.
Right.
But the talent agent, they just take a percentage fee for managing the star's career with almost zero downside risk.
That makes total sense. So they aren't holding massive capital reserves against wealth management accounts because it's not actually the bank's money at risk.
Exactly.
They're just managing the client's assets for a recurring fee.
You nailed it. And the scale is staggering. AWM net income rose 12% to $1.8 billion. But the real indicator of future shareholder value is the assets under management, or AUM.
What were those numbers?
That surged 16% to $4.8 trillion. And that was fueled by $54 billion in long-term net inflows in this quarter alone. Yeah, managing nearly $5 trillion generates incredibly predictable, high-margin revenue, and it doesn't tie up the bank's internal capital.
Okay, so we have the CIB dominating global market share. We have the CCB leveraging digital flywheels to lower costs, and AWM printing high margin fees.
The machinery is flawless.
It really is. But what does this actually mean for capital distribution? How much of this profit is finding its way back to the actual shareholder?
The short answer is almost all of it.
Really?
Yeah, if we look at the last 12 months, the net payout LTM, that figure sits at 82%.
Okay, just to clarify for you listening, an 82% net payout means that for every dollar of net income the bank generates, 82 cents are handed right back to investors.
Right.
In Q1 alone, they paid $4.1 billion in common dividends, which is $1.50 per share. And they executed $8.1 billion in stock repurchases.
And those buybacks are critical.
Mhm.
By actively retiring billions of dollars worth of their own shares, they shrink the total number of shares on the open market.
Which organically drives up the earnings per share we talked about earlier.
Exactly. It's a mechanism that forces the market to respect their valuation
Yeah.
because it proves these aren't just, paper profits. They are converting earnings into realized tangible value.
But I have to play devil's advocate here for a second.
Go for it.
Paying out 82 cents of every dollar feels almost reckless if you are simultaneously warning about a Category 5 hurricane. Which brings us to CEO Jamie Dimon's economic outlook.
Right. The CEO's letter.
Yeah. He's hoarding $1.5 trillion in cash, yet paying out 82% of earnings. What exactly is he seeing on the horizon?
Well, it's a really nuanced forecast. Dimon actually outlines several major tailwinds propelling the U.S. economy forward first.
Okay.
He notes the resilience of consumer spending, the ongoing impact of fiscal stimulus, the massive capital investments being driven by the AI boom, and the anticipated benefits of deregulation. Those forces are providing real lift.
Right, and just to be clear for the listener, we are simply reporting the macroeconomic factors Dimon cited in his release as drivers of their strategy. We're not taking a stance on the politics of deregulation or stimulus.
Of course. But those tailwinds are heavily shadowed by what he views as severe compounding headwinds.
And this is where the geopolitical risk premium comes in, right?
Exactly. Dimon is raising major alarms about ongoing global conflicts, extreme volatility in energy markets, and fracturing trade relations.
It's a lot.
And add to that the massive global fiscal deficits and what he considers elevated asset prices across the board.
See, it's easy for CEOs to issue vague warnings about, geopolitical uncertainty. But I want to know how that dread actually hits the profit and loss statement. Does his anxiety show up in the Q1 numbers?
It absolutely does. Operating in a high-risk, complex global environment is incredibly expensive.
Where do we see that?
In their non-interest expenses, which jumped 14% to $26.9 billion. A large part of that is compensation and marketing, sure, but it also reflects the sheer cost of compliance, security, and strategic maneuvering.
And what about credit risk? We mentioned earlier they aggressively grew their loan portfolio, especially in credit cards.
Right. Well, that's where we see the macroeconomic forecasting models directly impact the balance sheet. They reported a $191 million net reserve build for credit losses.
So just to clarify, the $191 million isn't a realized loss yet.
No.
It's essentially an algorithmic calculation looking at those macroeconomic headwinds Dimon mentioned and forcing the bank to lock away an extra $191 million from their profits today, just in case those loans sour tomorrow.
Exactly. It's the cost of prudence. Now, they did report $2.3 billion in actual net charge-offs. Those are loans they've had to write off completely.
Right.
So the underlying consumer stress is real, but the reserve build shows they're structurally anticipating more pain ahead.
Okay, looking toward the rest of 2026, the guidance suggests they expect net interest income to land at roughly $103 billion, and they're projecting that card services charge-off rate to hold steady at around 3.4%.
Right.
But beyond the macroeconomy, there's a significant regulatory cloud looming over these targets.
Yeah, you're referring to the proposed changes in capital rules, widely known in the industry as the Basel III Endgame.
Yes, the Basel III Endgame. Dimon was particularly vocal about this. But if the bank already has $291 billion in core equity and $1.5 trillion in liquidity, why are they so concerned about new capital regulations?
Because the proposed Basel III rules would fundamentally require major banks to hold even higher levels of capital in reserve against their risk-weighted assets.
Even more than they already do.
Exactly. And Dimon made it clear that, look, while JPMorgan easily has the capacity to absorb these rules right now, overregulation carries a massive opportunity cost.
Meaning every extra $1 billion regulators force them to lock in the vault is $1 billion they cannot deploy into the real economy.
Precisely. It restricts their ability to lend to, say, a mid-sized manufacturer trying to build a new factory or a family trying to secure a mortgage.
Right.
The argument is that forcing banks into an ultra-conservative posture actually chokes off long-term economic growth just for the sake of marginal systemic safety.
Well, so let's pull all these threads together for you listening. What is the grand synthesis of JPMorgan Chase in Q1 2026?
It's a masterclass in balance.
It really is. You have the corporate and investment bank dominating global fees and thriving on market activity. You have the consumer bank utilizing targeted tech investments to build this highly efficient, low-cost digital deposit base.
Yep.
And you have asset and wealth management generating phenomenal 44% returns through a capital-light, fee-driven model.
And all three of those engines are simultaneously funding a $1.5 trillion defensive fortress while returning 82% of all generated profit directly back to the shareholders.
It's wild.
It is a level of scale and execution that frankly dictates their absolute premium in market valuation.
It makes perfect sense when you lay it out like that. But I do want to leave you, the listener, with a final thought to chew on regarding that $1.5 trillion fortress. We spent this whole time analyzing how their massive cash hoard protects them from traditional geopolitical and economic shocks.
Right. But consider how the nature of those shocks is fundamentally changing.
Exactly.
In an era fueled by artificial intelligence, algorithmic trading, and instant digital capital flight, financial crises no longer unfold over weeks.
No, they can happen in hours. Look at the recent bank runs. They were fueled by social media panic and executed via mobile banking apps at light speed.
Which raises the ultimate question for the future of global banking. As money moves faster than human comprehension, will a traditional balance sheet fortress be enough?
Right.
In the coming decade, the greatest defense mechanism for a bank might not just be how much physical liquidity it holds, but how instantaneously its technology and its leadership can adapt to a crisis unfolding at the speed of an algorithm.
It's a great point. A thick, heavy hull is fantastic for surviving a hurricane, but, if you can't turn the ship fast enough, you might still hit the iceberg.
Exactly.
Well, thank you for joining us on this deep dive into the mechanics of global finance. Keep questioning the numbers, and we'll see you next time.